Preparing for a FactSet interview questions interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work at FactSet? I'm drawn to FactSet because it sits at the intersection of finance, technology, and client problem solving. Its products are embedded in how analysts, portfolio managers, bankers, and researchers make decisions every day. I like that the role requires market knowledge, data accuracy, and communication, not just one skill. I would get exposure to real investment workflows while helping sophisticated clients solve practical problems under time pressure. While answering, focus on FactSet's mix of financial data, analytics, technology, and client service. Show you understand its users and connect your motivation to markets, problem solving, and learning investment workflows. Question 2. What does FactSet do, and who are its main clients? FactSet is a financial data and analytics platform used by investment professionals to research securities, build models, monitor portfolios, and manage market data. Its clients include asset managers, hedge funds, investment banks, wealth managers, and corporate teams. The value proposition is workflow efficiency. Instead of pulling data from many sources, users access standardized fundamentals, estimates, ownership, pricing, news, screening, and portfolio tools in one environment. Make sure to cover FactSet's core products, target clients, and value proposition. Mention research, analytics, portfolio tools, market data, and how integrated data improves investment and business decisions. Question 3. Walk me through the 3 financial statements and how they connect. I think of the statements as one connected story. The income statement shows profitability over a period, the balance sheet shows financial position at a point in time, and the cash flow statement explains how cash moved. Net income flows into retained earnings and starts operating cash flow. Depreciation reduces income, but is added back in cash flow. Capital expenditures reduce cash and build PP&E, while debt changes affect both cash and liabilities. In your answer, talk about how the income statement, balance sheet, and cash flow statement connect. Emphasize net income, retained earnings, depreciation, CapEx, working capital, and balance sheet integrity. Question 4. How would you explain enterprise value to a client? Enterprise value is the value of the whole operating business independent of capital structure. I calculate it as equity value plus debt, preferred stock, and minority interest, minus cash and equivalents. It matters because buyers usually assume or refinance debt, but can use excess cash. When comparing companies with EV/EBITDA, EV matches a pre-financing numerator with an operating denominator, making valuation more comparable across leverage profiles. Be sure to mention the formula, why cash is subtracted, why debt is added, and how enterprise value supports valuation multiples used by bankers, investors, and FactSet clients. Question 5. If depreciation increases by $10, how does it affect the 3 financial statements? With a $10 depreciation increase, pre-tax income falls by $10. Assuming a 25% tax rate, net income falls by $7.50. On the cash flow statement, net income is down $7.50, but depreciation is added back by $10, so operating cash flow rises by $2.50 from the tax shield. On the balance sheet, PP&E falls by $10, cash rises by $2.50, and retained earnings fall by $7.50. While answering, walk through all 3 statements step by step. Use an assumed tax rate, show the tax shield, and confirm how the balance sheet still balances. Question 6. How do you value a company using a DCF? A DCF values a company based on future free cash flows discounted back at the appropriate required return. I would project revenue, margins, taxes, working capital, and CapEx to calculate unlevered free cash flow. Then I would estimate terminal value using an exit multiple or perpetuity growth method, discount everything at WACC, and subtract net debt to reach equity value. The key is testing assumptions, because small changes can drive large valuation swings. Make sure to cover free cash flow projection, the WACC, terminal value, net debt adjustment, and sensitivity analysis. Keep the explanation practical, because FactSet roles often support users building valuation workflows. Question 7. What are trading comparables, and how would you choose a peer group? Trading comps estimate value by looking at how similar public companies trade. I would select peers with comparable business models, revenue drivers, margins, growth, geography, and capital intensity. Then I would calculate multiples like EV revenue, EV EBITDA, and PE, adjust for outliers, and apply an appropriate range to the target. The hardest part is not the math. It is choosing truly comparable companies and understanding why multiples differ. In your answer, focus on peer selection, relevant multiples, normalization, outlier treatment, and limitations. Stress that comparability and business judgment matter more than mechanically applying an average multiple. Question 8. A client says FactSet EPS does not match a company filing or another data provider. How would you investigate? First, I would stay calm and clarify the exact metric, company, period, and source the client is comparing against. EPS can differ because of generally accepted accounting principles versus adjusted treatment, share count methodology, restatements, fiscal calendars, or timing of data updates. I would check the source document, audit the data lineage, reproduce the calculation, and explain the variance clearly. If it is a data issue, I would escalate with evidence and keep the client updated. Be sure to mention source documents, adjusted versus reported metrics, fiscal periods, share counts, data timing, and escalation. Show a client service mindset. Clarify, investigate, explain, and follow through. Question 9. How would you handle an angry portfolio manager whose FactSet report is not working before a meeting? An upset portfolio manager usually needs speed, ownership, and clarity. I would acknowledge the urgency, restate the issue, and separate immediate workaround from root cause analysis. If a portfolio report failed before an investment meeting, I would first help generate a usable output, then investigate permissions, data feeds, formulas, or settings. I would avoid overpromising, provide time-stamped updates, and close the loop once the issue is resolved. While answering, focus on empathy, urgency, problem diagnosis, workaround creation, escalation, and communication cadence. FactSet interviewers like to see calm ownership under pressure with demanding financial professionals. Question 10. Explain a recent market event and how it affected investors. One recent theme I would discuss is how higher for longer interest rates affected equities. Rising yields increase discount rates, pressure long-duration growth stocks, and make bonds more competitive versus equities. At the same time, banks, insurers, utilities, and highly levered companies feel the impact differently. I would connect the event to valuation multiples, earnings expectations, sector rotation, and portfolio risk, rather than just describing the headline. Make sure to connect the event to markets, sectors, valuation, earnings, and client relevance. Avoid giving only headlines. Explain cause, effect, and what an investor might monitor next. Question 11. What is beta, and why does it matter in valuation? Beta measures a stock's sensitivity to movements in the broader market. A beta of 1.2 suggests the stock tends to move 20% more than the market, assuming the historical relationship holds. In valuation, beta feeds into CAPM and the cost of equity, which affects WACC and DCF value. I would also mention that beta is backward-looking and can be distorted by leverage, business mix, and the chosen index or time period. In your answer, define beta simply, explain interpretation, connect it to CAPM and WACC, and mention limitations such as historical estimation, leverage, index choice, and business changes. Question 12. How do rising interest rates affect equity valuation? Higher rates usually reduce equity valuations through two channels. First, the discount rate rises, so future cash flows are worth less today. Second, financing costs increase, which can pressure earnings, leverage capacity, and investment plans. The impact is largest for long-duration growth companies and highly levered businesses. However, some financials may benefit from higher net interest income, so I would avoid a blanket answer and analyze sector-specific exposure. Be sure to cover discount rates, borrowing costs, earnings pressure, sector differences, and duration of cash flows. Show you can translate macro changes into valuation and portfolio implications. Question 13. How would you use SQL or a data check to find duplicate security records?
I would start by defining what should be unique. For example, security identifier, date, and data item.
In SQL, I would group by those fields and use count greater than 1 to identify duplicates. Then I would inspect whether they come from multiple share classes, vendor mappings, stale identifiers, or loading errors. The goal is not just deleting rows. It is preserving valid securities while fixing the upstream data rule. While answering, focus on defining uniqueness, using group by logic, validating identifiers, distinguishing true duplicates from legitimate records, and fixing the root cause rather than only cleaning symptoms. Question 14. How would you prioritize multiple client issues during busy market hours? I would prioritize by client impact, market sensitivity, deadlines, and whether a workaround exists. A trading or portfolio reporting issue near market open gets immediate attention, especially for a high-impact client. I would triage quickly, communicate expected timing, and escalate if another team owns the fix. For lower severity requests, I would set clear expectations. Good prioritization is about protecting client workflows, not just answering tickets in arrival order. Make sure to cover severity, client impact, market deadlines, workaround availability, escalation, and transparent communication. Show that you can balance responsiveness with disciplined prioritization during busy market hours. Question 15. Tell me about a time you learned a complex financial tool or data set quickly. I would answer with a specific example, like learning a valuation model, Bloomberg function, Python library, or internal reporting tool under a deadline. My structure would be situation, action, result. I would highlight how I broke the tool into core workflows, practiced on real cases, asked targeted questions, documented shortcuts, and delivered output. FactSet values people who can learn quickly and then make complex tools usable for clients. In your answer, use a concrete STAR example. Highlight speed of learning, breaking complexity into workflows, asking precise questions, documenting lessons, and applying the tool to a real output. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.